Good afternoon, everyone, and good morning to those of you that are in the central and western parts of the country. My name is Jim Scanlon. I'm the head of relationship management here at the firm. I'd like to welcome you all to the June installment of our monthly strategy update and market outlook. We're almost halfway through 2024, and uncertainty and angst among investors remains high. Our goal, as we've said before, is to make this webinar as helpful and as informative as possible, and to also do it in a timely manner. We know everyone's quite busy, so let's go ahead and get right into it. I'm joined, as always, by our head of research and co-portfolio manager, Jim Warner. Jim will share his thoughts and walk us through this changing landscape and how we're positioned to both face the challenges and take advantage of opportunities. Before I turn it over to Jim, just a reminder that we encourage and welcome questions. Questions are anonymous, and so please, at any time, click the Q&A button at the bottom of your screen, and you can do that at any time during the presentation, and we will address those questions at the conclusion of the meeting. And so with that, Jim, I'll turn it over to you.
Great, thanks, Jim, and thank you to all who are participating today. And yeah, I really would underscore that we'd love to get questions. This is an opportunity, I think, for you to understand a little bit better about how we think about the world, how we're creating, constructing portfolios, and also just if you're a financial advisor and you're getting questions from clients that you don't have answers to, use this as an opportunity to float those. So while you're thinking about that, let me share my screen. And as a portfolio manager, my job is to kind of look around the corner and figure out what to worry about that nobody's worrying about, in short. And so one of the things that we spent the last month focusing on is the consumer. We've talked a lot about inflation, and that's still a key narrative of the market. But I think we need to now turn our sights towards what's happening with the consumer. And we're gonna spend a little bit of time on that subject, among other things today. So just to summarize on where we've sort of been in the last couple of months. 2 months ago, we warned people that we were due for a 5% pullback. We got that. We mentioned that, a month ago that it was a good idea to buy the dip. We did. And we've had a nice little rally off that bottom. So May actually ended up being a pretty fantastic month for the S&P and particularly for the NASDAQ. We've talked all year long about the market broadening and having more companies participate in the upside other than just the Magnificent Seven, right? That was a big theme last year. First part of this year was really shifted in tone to AI. Well, we kind of shifted back to that narrow AI-focused tenor. And so you can see that the equal weight was really only up 2.8% during the month of May, and the Dow Jones was only up 2.6%. So we're getting back into this kind of narrow market. We generally don't prefer narrow markets. We prefer broader markets. It gives you more diversification in your portfolio. But nevertheless, this is where we are. And as you know, and we talked a bit about this, really consistently throughout the year, bonds continue to be the big drag. The aggregate bond index is down about 2% for the year. This is where your safe money is supposed to be. This is, where you're not risking money. That's how most portfolios are constructed for clients. But yet we're going through yet another year of negative returns. And obviously the very simple reason for this is that higher than expected inflation, particularly during the first 3 months of this year, has led to higher interest rates. Now, we're going to talk a little bit about why we continue to believe that this could pivot, and we'll point to some more evidence as to why that could be the case. But for now, this has been the biggest laggard in most client portfolios and certainly our own. And obviously what the narrative is today is that we're going to have higher interest rates for longer. And, the first 3 months of the year, we got hotter than expected CPI prints. And this took down rate cut expectations from 6 to 7 entering this year down to essentially 1-ish. And what this, we've always looked back to the Fed funds curve, which is essentially where interest rates are on the curve, and look at them on the dates of future Fed meetings, which you can see on the bottom below. And importantly, what you've seen is that in end of March, we saw kind of a big correction up. So that's the light blue line to the gray. you sort of saw this big ratchet up. It's really most evident at the, in the January 29th meeting, where rates were expected to be at 4.4%. They reset immediately to 4.9. That's what really drove the pullback in April. And we really have seen kind of a leveling out since then, which is very positive, honestly, for lower bond volatility as well as for bond prices overall. So we're basically at about a cut for this year. And if you really look at the probabilities, some think it might happen before the big election. The election day is November 5th. There's a meeting 2 days after. And so the market's kind of split on whether we get this 25 basis point cut before or after the election. Now, obviously, what's driving this has been inflation metrics. And so as we've talked about previous months ad nauseum, really, is that, that this is really what's going to drive interest rates. It's going to drive the market narrative. And don't forget, as I just said, that we've had a couple of higher than expected CPI prints. Well, that reversed in April, where we actually got a lower than expected CPI print. But for now, I think the consensus really still remains is that higher for longer rates because we have sticky inflation. Now, but if we look instead at the Fed's preferred inflation gauge, the core PCE, which excludes food and energy, the inflation data here is less concerning than what we're seeing in the CPI. And as we talked about a lot, and I don't go into it at all in this presentation, but I'm happy to address it on a Q&A. It's stubborn housing prices have really kept core PCE elevated. So underneath, if you were to peel out housing prices from that 2.8% for last month, what you would really find is housing, which is about 20 to 25% of core PCE, is running still hot at around 5.6%. Now, we've seen a lot of evidence in the real estate markets that various markets, particularly in the South, are really weakening pretty dramatically. So our overall expectation is we're going to continue to see a downward pressure on inflation and therefore interest rates at some point. Now, what keeps us up at night, and I think this is the question I get from clients all the time, is what keeps you up at night? And it's this metric that I developed, which is looking at the Fed funds effective rate. So this is every single day, the overnight repo rate, which is supposed to be reflective of the Fed funds target trades. And so we have a real-time view of what the overnight rate is. And that's essentially what the Fed controls. It's running at around 5.3%, for example. And then we subtract from it core PCE, which is your 2.8%. And what you get essentially is a spread. Now, what we looked at when we went back in history was that the last time we got to levels where the spread, where essentially the Fed's rate was this much higher than inflation, we ended up getting a really serious crash in the market. We had the global financial crisis, was the last time, and the time before that was the dot-com crash. Now, what followed the dot-com crash was a very shallow recession. Obviously, asset prices got hit very hard, but the economy really only went through a very shallow recession. The global financial crisis was obviously stemmed from a housing crisis and then a banking crisis as a result, much bigger deal, much deeper recession. Now, we're not suggesting that we're facing some sort of a crisis. We could be facing a recession. And so, but what this chart says to me is I need to start working on researching what could cause the next recession, or where are the cracks in the economic pudding, if you will. So we turn to the consumer, which we haven't really spoken a lot about, largely because when you look at the unemployment rate, you look at the participation rate, which is pretty high, and you see a very strong labor picture, right? It's historically strong by any perspective. And so this is what's supporting consumer spending. And we'll talk a little bit in a second about what's happened in consumer spending, but essentially people have jobs, and that's good, and that promotes consumer spending, which is, the vast majority of GDP. But one of the things that we expect, or that we might be concerned to see, is a softening in the labor market. Now, in April, payrolls came in light. this is actually almost about a month ago when we received this data. The 175,000 was a bit lighter than expected, and that actually helped propel the market upward. Now we get another print this Friday, and it's very important where this comes out. Basically, anything sub 200 really means that we're kind of net losing jobs in the economy. You need something greater than 200,000, generally speaking, to sort of really see the labor market grow. So this is a very important data point. So, at 7:30 Central, everyone should be waking up and listening to see where these payrolls are going. That's going to be a key indicator. For now, a slightly weaker than expected payroll number is going to allow stocks and bonds to rise. So we want a slightly weakened labor market from the perspective of asset prices. But of course, we don't want it to weaken too much because that pushes the economy into recession. So this is a very key data point to pay attention to. Now, we've also talked about the two canaries in the coal mine, and they continue to normalize or weaken. So in the graph on the left, you have the JOLTS job openings. And what you can see is that, and another print came out yesterday, is that we're basically back around 8 million job openings. Now, if you compare that to where we were pre-pandemic, and by the way, this was a very strong labor market in 2018, 2019, sub 4% unemployment rate. You had about 7 or 8-ish million job openings. So we are just now normalizing back to what a very strong labor market looked like pre-pandemic. We had this big, huge surge in job openings when businesses were having a tough time finding labor. This is now normalizing. Now, can we say that this is a weakness? Not really, not yet. But this is one of the canaries in the coal mine that we need to focus on and pay attention to. The other one is temp jobs. And we've talked about this in months past, but temp jobs are important to watch because they're the first people that get hired when you're coming out of a downturn, and they're the first people to get fired when you're going into one. And as you can see by the chart on the right, there's actually a degree of weakness now in the temp world. You can see that we're well below, where the 2018, 2019 levels are. So we're keeping a close eye on that. So, but in light of the strength of this labor market thus far, we've had the consumers have had this incredibly strong amount of spending. And you can see on the chart on the left that personal consumption expenditures, that's just fancy for spending, has continued to grow. Now, one of the most interesting things that we went back and looked at was that if we look at this growth from pre-pandemic, sort of end of 2018 to the end to where we sit today, the growth is roughly about 28% or so. Just simple math. Now, of that 28%, guess how much of that is due to inflation? Well, it's roughly 75%. So 75% of the increase in personal spending in this country is simply due because the same product is now that much more expensive. And so that means that only about a quarter of this increase, this big, huge increase that we've seen from, roughly 15 trillion to almost 20 trillion is essentially unit growth, or people consuming more things, more units. And so I think that's actually a very interesting perspective when you think about spending. So it's really been inflation that's forced this higher spending. It makes me feel a little bit less confident that this is as strong a number as it would imply in this graph. And so how are people making up for this extra inflation, and how are they able to keep up with this inflation? Well, it appears that they're robbing their savings. And so if we look at personal savings on the right, you can see that it's been pretty low ever since folks burned through their stimulus payments. That's this big spike here in March of 2021, which we all know about. But you started to see personal savings decline and decline. And in fact, if you took the savings rate, which is really comparing this dollars of savings versus incomes, we've now declined below pre-pandemic levels. So consumers are really robbing their savings to keep up with spending. And one of the ways that they're also keeping up with spending is racking up more and more credit card debt. And as you can see with the graph on the left, we've had a pretty big surge. This is basically about a 50% surge in credit card receivables, over just the course of the last, 2.5 years. And if you look at it on the graph on the right, the average credit card interest rate has basically doubled since pre-pandemic, and we've seen this massive surge, right, since the Fed started raising interest rates. We've gone from roughly around 14% on average to close to 22%. So what this means is that consumers have a much higher future debt payment burden. And so you then marry that with, we have inflated prices. How sustainable is this spending or borrowing behavior? That's really the key question that we're asking ourselves. So I'm going to pause there, but if you're starting to think about what are the data points that we're looking at, as we are really trying to figure out whether the consumer is going to crack. Now, one of the things that really could cause the consumer to crack is if we started to see a bunch of layoffs, right? If we started to see that payrolls get really weak, unemployment rates spike, then you can be rest assured that consumer spending is going to take a hit. So when we think about constructing our portfolio, we want to avoid areas like that in the economy. We want to avoid places like consumer discretionary, by and large, that are going to, potentially face some serious headwinds. We have been avoiding consumer credit because we're worried about the health of the consumer going forward. Now, this isn't to necessarily raise complete alarm bells, but it's important that as we develop this thesis and we follow the data, that we sort of make sure that we cut back on the risks that we're taking related to the consumer, and we've been doing that. Now I'm going to shift topics a little bit and talk about some of the themes that are currently in our global vigilance strategy, which is really our flagship strategy. And we have multiple different blends of risk, but this is kind of our core strategy. And as most of you know, we're very tactical, and we're also very multi-asset class. So unlike a lot of other folks that are in the tactical world, we actually have exposure to a pretty significant exposure to commodities, even sometimes currencies. So non-traditional assets that you would typically find in a client's portfolio. So one of the ones that we wanted to talk about today was the investment that we've made in gold and also gold miners. And back in 2022, and this also, we do this for your benefit too, to help you understand how we think about positioning portfolios. So back in 2022, recall what was happening. We were having the increase, you had big increases in the Fed funds rate and in interest rates. We were going basically from a zero interest rate environment to something much higher. And of course, what didn't work and what we expected not to work were bonds, right? The aggregate bond index finished 2022 down 13%. And we had a feeling that we knew that basically on our work that what you did not want was interest rate sensitivity. So we, pushed all of our bond exposure into short duration. And then we needed to find some other hedge in the portfolio to guard against equity volatility. And so we chose gold. And so we bought gold back here in May of 2022, and we bought some more in December. And it's proven to be, a terrific trade. Now what's happening is that a lot of central banks around the world are buying gold. And so, this has been a terrific trade, and we expect it to frankly go much higher. Along about March of this year, we decided to enter into gold miners shares. And gold miners are essentially a levered bet on gold. They had, as you can see in this chart, because this is a normalized chart too, it starts at 100. You can see the massive underperformance of the gold miners relative to gold. And so when we saw this, we decided that it was a good time to put that trade on. You can see that it's actually worked out quite well. The other theme that we wanted to talk about here is, because the name global vigilance implicitly or explicitly means that we invest globally. It's a reminder that you don't have to just buy US stocks. In fact, if we have issues with the US economy, well, why would you want to buy US stocks? Certainly there are going to be great ones to own, but you can go elsewhere, and that's what we do. So back in actually late 2020, we bought what we think is the best bank in India. It might even be one of the best banks in the world. It's ICICI Bank. And the reason why we did this was twofold. Number one, the it's an excellent bank, well managed, great loan growth, very few credit issues. But really what banks are levered bets on a country's GDP growth. And as you know, India is essentially the fastest, largest growing economy in the world at 7 or 8% GDP. Half the $1.4 billion population, which is massive. Half of those folks are under the age of 30, which provides huge future growth tailwinds, which frankly, a lot of Western and even Asian economies do not have the benefit of. They have aging demographics. India has a growing middle class. It has world-class universities, advanced technology and pharmaceutical industries. And all in all, what we were able to do is essentially buy an Indian bank, which, to folks who don't know, have a lot of experience investing internationally, may not understand, but you can see that it vastly outperformed Apple, which everybody's familiar with and a lot of people like. And so the idea here is that you can find great compounding stocks that can even outperform some of the best companies in the US market if you know where to look. And so we love this trade. I got a question yesterday about the recent volatility we saw we've seen in both ICICI Bank shares as well as the Indian stock market. And a lot of that has to do around the re-election of Prime Minister Modi for a third term. A lot of this is essentially noise, but what he has now done is created a coalition that now isn't just his own party; it includes other folks. And actually, we think that that's probably net going to be a good thing. We can talk more about that if you're interested. So, from a portfolio positioning standpoint, this is the way we would characterize the market today and where we think it's going. Obviously the market backdrop here is consensus believes that inflation is going to be sticky, and hence we're going to have higher for longer interest rates. But at some point, this view is wrong, and we've been the first to try to point out or look for where that might be the case. Could it be housing prices rolling over and really dragging down inflation and therefore interest rates? Could it be the consumer cracking? But that's why we do the analysis that we do on both housing and consumers to understand when will this consensus narrative change, and we want to be properly positioned ahead of that. That's really the whole foundation of being tactical, which is to dynamically change the allocation of the portfolio either by asset class or even toggling defensiveness or aggressiveness of the equities that we're invested in. We make these changes real time based on the information that we get. The economy obviously remains strong, but I just showed you some areas where the consumer might be facing some headwinds. And as we always like to say, market pullbacks are inevitable. You'll get multiple 5% pullbacks during the course of any given year, irrespective of a changing macro picture. And these need to, I think for now, be viewed as buying opportunities, just like last month opportunity created. And the reason largely for this is that so long as the overall economic picture hasn't changed much, there's $6 trillion of money market assets that we talked about, I think last month or the month before, that has to come off the sidelines at some point. So there's going to be some folks that are no longer going to be happy earning 5% on their money market, but they want to buy the dip in NVIDIA or whatever, or in the market in general. So there is definitely a bid in the market for risk assets on these pullbacks. And so far, what we've seen is that bad or slightly weak economic news is good for the market. So if we get a weak payroll number on Friday, I would imagine the market goes up, interest rates come down, both good for both stocks and bonds. And so for the next 3 to 6 months, our short-term view is that the equity market could continue this bull market rally, but we would urge people to resist the need to be greedy, to do exceptionally risky things. There's lots of value in this market outside of the Magnificent Seven. You need to have exposure to both is basically what I'm saying. What we obviously need for this bull market to continue is inflation-friendly data. And so now we've gotten now a good solid month of that. We need to see that continue. So that's obviously a focal point. So in light of all of this, we think that, short-term stocks and bonds should, continue to perform well. And really, in our mind, is this the moment where you really start to add to long duration bond exposure? Remember, we've talked about in the past how the convexity picture is setting up for a super attractive hedge in one's portfolio. Now, it hasn't worked because interest rates kept climbing. But as the interest rate environment starts to stabilize and potentially even see rates fall, then you're going to see these longer duration assets really work to hedge out losses, equity losses in the portfolio. So I think we are actually at a extraordinary moment in time, which most of us have never seen in our investment lifetimes. I've been doing this for 30 years and I haven't seen it, but the opportunity to buy essentially distressed investment grade that has long duration is one of the most interesting hedges I've seen in a long time. And you feel free to call us and talk to us more about that. Medium term, I think that equities could face some more headwinds, particularly if the economic news continues to decelerate. So we really are being very careful about which stocks we own. We don't think this is a market where you just own the index. It really matters what you own. Because basically the Fed, we don't think is going to be much help in the near term. My greatest fear, as I alluded to earlier, is that we are at a point where rates may be too tight relative to inflation, and the Fed may wait too long before they start cutting. And remember, it takes 18 months or so for a Fed rate hike to really flow through the economy. And so we're basically not even through all of the Fed rate hikes. We have not digested all of them. We're not really sure, what impact that's going to have on business. Let's say for businesses who now experience higher interest expense, do they start laying off workers? So far, so good. And we really hope that continues. But we're very conscious of the fact that we have not seen the full impact of interest rates yet. And so this is sort of the key risk, that we don't expect that the Fed could be too late to cut, and therefore we don't really have that Fed put under the market. That said, just to take off my negative hat for a second, there is a lot of value in both the stock and bond markets, but really, as long as we stomp out inflation, there's a lot of value out there still. And so the way we're doing that and capturing that is sticking to strong secular themes. So this chart is basically an infographic of the secular themes that we're involved in. I mean, if you watch us every month, you see it. You see this slide gets updated. But the key things that we're really focused on are things like AI and data and the cloud computing, the electrification, if you will, of the world, really, as we have more applications like electric vehicles that need energy. We need a bigger grid. We need cleaner energy. We need sustainable energy. We need, even things like potentially uranium to generate power through nuclear reactors. So I'm happy to go through some of these in detail. But it's real. But what we've done essentially recently is we like where our portfolio is positioned. We made one small change in the past month after adding a bunch on that dip. We got out of our yen bet. But other than that, there's really been no material change in our positioning. And on our more aggressive product, Global Vigilance, which we call the Tilt, this is much more of a growth-oriented, for the growth-oriented investor with roughly 80% equity exposure. One of the places we got more aggressive was in biotech, LNG exports. We added some Amazon and copper. Copper, I'm sure everybody knows the thesis now, where the demand for copper is about to accelerate dramatically, and there's very limited supply. So that usually is how we like to set up any sort of commodity trade, is where we have constrained supply and an acceleration of demand. We think that's an area where you're going to see that. In addition, same dynamics in uranium. And then we got out of some of these enterprise software companies, which that's actually kind of in the recent days, the real big question, and where we've reduced exposure to is enterprise software, and how many of these business models are actually going to survive the AI revolution. So, you take something like these, like Salesforce or ServiceNow, which is the NOW here. These are business productivity applications, which frankly, through the application of AI and Microsoft Office, you may not even need these applications anymore. So there's, I think what investors are wrestling with right now is where is the role in enterprise software? And given that many of these trade at very large valuations, you're starting to see a correction in those names as investors try to get their heads wrapped around this. So let me stop there and take any questions. Jim?
Okay, Jim, thank you. We have a couple of questions in the queue here. And once again, if you have any questions at all, please click the Q&A button at the bottom of your screen. We'd love to hear from you. First up, more like a comment than a question, Jim. It's says here, not really a question, but anecdotal evidence about real estate. This individual put their Clearwater Beach condo on the market in December at the estimated market value, and got 0 offers over a 6-month period, even dropping the price twice by 10% each time. The realtor had said it was the first time ever in his career seeing no offers go for a beachfront property.
Yeah. Well, I feel for you, and you're not alone, if that's any consolation. We track what's going on in the Florida real estate market by the zip code, and it's really the epicenter of what's going on in housing. Clearly, the areas of this country that were not locked down in COVID saw a massive surge of population, and you then throw in Airbnbers that came in and bought all these properties. That was a kind of a COVID phenomenon. What's obviously happened in Florida is you've had like a doubling of property taxes, a doubling of property insurance. And then if, the condo market's particularly messed up with that new law that basically makes all of the condos within a certain distance from the coast have to go through, these massive engineering studies, which are costing, folks, which is basically raising HOA fees to astronomical levels. I mean, what's going on in the Florida housing market is nothing short of a disaster. And I don't really know how it's going to work out, but it's not just in Clearwater Beach. It is really throughout all the coastal sections, but you can even see it in places like Orlando, the Villages, a popular retirement community. Prices are off, as much as 25% from list. And so, yeah, what's basically happening, we've talked about this in prior webinars, is that the lack of affordability, both in terms of mortgage rates, which we know are 7% plus, but really in terms of price, the price appreciation is really created a massive disconnect between the bid and the ask. And I think just it's widest in a place like Florida, so it's going to be take a lot to find buyers to step in. It's worse for condos for sure than for single family houses, but there is the correction is very real. You're seeing that in other markets too, but maybe not to the same degree as what you're seeing across Florida. But take Austin, Texas. You've seen prices really correct as a lot of folks flooded in from California to the tech firms there, and now they want to move back, or the company, in fact, might have moved back. Like Oracle moved a bunch of jobs back, for example. The prices there basically doubled, same like as in Florida. And now, the folks that have to get out, right? The folks that can't afford that HOA payment, or they can't afford their new property taxes or property insurance. If you are a forced buyer and you're trying to get out, it's ugly. And it's ugly in Phoenix. It's ugly in Salt Lake City. It's ugly in a bunch. It's ugly even in Vail. You're seeing huge corrections in pricing, and it's not happening everywhere. The places where there are the outflows, like it's okay in New Jersey, it's fine. But in places where you saw big surges of movement, there's a really big correction that's going on. So yeah.
Okay, Jim, thank you. There's another question here in the queue. Do you monitor U.S. Treasury options, and are you seeing any weaknesses, especially with 10 years and out?
I mean, there's been a couple of sort of tepid auctions recently. It hasn't really moved rates. As obviously we had a tepid auction in the last, week or two, we've seen rates go down. There's an insatiable amount of demand for the short end of the curve. There's still plenty of people who want to pile into 2-year T-bills. And so there's actually recently been a lack of supply coming online. But largely we haven't seen, everybody says like, oh, we do have a way too big a deficit. There's lots of supply. Surely this is going to force rates up, but you just need to put everything into perspective. Do you want a U.S. Treasury that's yielding, 4.32% on the 10-year today? Or do you want a JGB that's like 0.8%? So everything's relative. As to try to say it in politically correct terms, we're the biggest small person on the planet. As messed up as our national debt is and the deficit and all that needs to get fixed, the reality is we have not seen really sufficient weakness. Now, we also have a Treasury Department that is really poorly run. Don't forget, we could have refinanced the entire U.S. debt at 2.5% for 30 years, just 2 years ago, but didn't. And so what you see is basically, kind of a very, I think, uncoordinated issuance across the curve. And then, of course, we're going to have to watch what happens to rates. So if the Fed starts cutting rates, that's going to change the equation. As much as 6 trillion, right, is in money markets that would need to come out. There's probably, I don't know what the numbers are, but there's a lot of folks that own Treasury bills, anywhere from 30 days out to 2 years, that if the Fed starts cutting rates, that's going to be, not as interesting a place to be. And maybe they move out the curve, and maybe that becomes the demand for Treasury to issue at the longer end of the curve. We don't know how this plays out, but right now we're not seeing any scenario. Most importantly, what we're not seeing is something that would create a shock. That's what we worry about. It's something that would create a shock to interest rates. But right now we don't see the conditions for that.
Okay, great. Thank you, Jim. And I think that wraps it up for questions here. I don't see anything else in the queue at this point. So we can go ahead and wrap up. As we do, I'll just make one comment I've noticed, and I know you have as well, Jim. We've seen a fairly consistent increase in the number of attendees that have joined us each month over the last 6 or 8 months. And some of the names are folks that have been investing with us for quite some time, and some are newer. And we're grateful for the opportunity and for the trust that you place in us to manage your irreplaceable wealth. It's a responsibility we take incredibly seriously. It motivates us every single day. And on behalf of Jim and Rick and the rest of our team here at Lear Investment Management, we really appreciate you joining us. And Jim really means it when he says, call us. If you want to talk with us, call any of us. If there's anything we can do to help you, answer any questions you might have, we're here to support you in any way that we can. So thank you for joining us, and have a great day. Thank you so much.
Thank you.